I'm happy to be here today and appreciate the opportunity to take some time and talk about the global markets. As Paul said, that's the work we do. We do analysis, forecasting, research in the global protein markets, beef, pork, and poultry. So that's kind of the background that I'm coming to you from here today. Do we have any hockey fans? Does anyone out here follow hockey? Stanley Cup playoffs going on right now, right? My wife's Canadian, so we watch hockey. I didn't watch hockey until I married a Canadian, and now we sometimes rabidly watch hockey. And the real rub is in the Olympics, because it usually comes down to U.S. and Canada, and it hasn't turned out well for me the last few years. But so we've kind of watched hockey. But Mark Gretzky, of course, everyone knows, or Wayne Gretzky. Everyone knows who Wayne Gretzky is, right? The great one. Wayne Gretzky did an interview one time, and they asked him, what was your key to greatness? How did you become a great hockey player? And he said, as I played hockey, I just got it trained into my mind. I never was skating to the puck. I was always trying to skate to where I thought the puck was going to be. So that's what made him great. He just got really good at knowing where the puck was going to be. And so what we're talking about today, I don't know where the puck is going to be, but I have a lot of charts and data and information that I think will help us maybe zero in at least the general area where the puck is going to be. I want to take some time today. I'll just go through a global pork update. We'll talk about some of the key issues, Brazil, Europe, China, and then we'll drill in and talk about the U.S. situation. So when we look at the global economy, that's a key driver here of pork demand. Really a key driver in Asia is global economics. When you think about global commodities, strong economies boost commodity prices. I'll talk a little more about that in a minute. But right now the global economy is fairly weak. We have some real challenges. We have 8 countries now that have negative interest rates. Negative interest rates. Think about that. This is an experiment. This is not something that's been done before. This is a trial to see if the central banks can force cash into the economy. They said, we're tired of banks sitting on cash. We want more cash in the economy. So we're going to put negative interest rates on you. That wasn't me, was it? But it only works one way. My first thought was, okay, sign me up for a loan. Negative interest rates, I'll borrow $1 million, just pocket the change every day. No, it doesn't work that way. It's the central bank rate, and it only works on deposits. But it's a huge indication of real weakness in those economies. And you think about it, the biggest economies in the world outside of the U.S. are Europe and Japan and China. All 3 are wobbly right now. Europe and Japan both have negative interest rates. And so we have some real challenges there. Some of the developing economies are having struggles right now. We have a debt crisis in Brazil, debt crisis in Russia. And so the economic winds are not favorable to the commodity world today. Another major factor has been the dollar rates. And this chart shows dollar rates, these currencies falling against the stronger U.S. dollar. And so the U.S. dollar would be along the 0 axis. This starts July 2014, the cumulative change. And so as that dollar strengthened, these currencies fell. And so you think about what that means. If we're competing with, say, Brazil, say we're shipping pork to Hong Kong, that Brazilian pork is now 37% cheaper versus the U.S. pork than it was in July 2014. And so that has a major impact. Now, in the big scheme, if you look at export markets, particularly U.S. markets, you look at Mexico, you look at Japan, these markets, they buy our product whether exchange rates are high or low. If you look at a 10-year chart, they continue to buy. This doesn't stop trade, but volatility in the short term can stall trade. No one wants to catch the falling knife, right? It's better to let that knife fall and then stabilize. And so as these currencies move, it just drives volatility into the markets. Now, I don't know where this dollar's going. There are a couple things at play. One factor that would cause the dollar to strengthen further would be an increase in U.S. interest rates. And the Fed, it looks like they're just chomping at the bit to try and get a chance to increase U.S. interest rates. We'll probably see a little bit of that. Also, if the U.S. economy outperforms other economies, that pulls money into dollars, and so that would also be a strengthening factor. Shift over and talk about commodity deflation. I mentioned this. This is a global food index. This is the United Nations data. Dairy, cereals, oils, those are edible oils, meat, and food. So this is the cost of food on a global macro index basis from 2000 through April 2016. You look at that, we've had some wild volatility, right? We had a huge spike ahead of ethanol. We had the ethanol boom that drove our corn prices up, shocked the world market higher. And then we had the global recession, which brought it right back down to earth again. We had the China boom, the crude oil boom. But look at where we are today. If you look at the right-hand side of that chart, right over here, we have 2 solid years of global food prices going lower. How many times has that happened over 16 years? Outside of the recession, we really haven't seen it. And so we have some pretty heavy deflation today. It's a factor of a few things. It's the mood and the money, right? We changed the mood, we changed the tone, and a lot of money pulled out. We saw a lot of Wall Street money in hog futures and cattle futures that in 2015 left those markets. And it started with crude oil. Crude oil tipped over, fall of 2014. Pretty soon the dairy market fell, the grain market fell, and lastly, the protein markets fell. So, I would tell you, I would have a hard time betting that this is going to continue. For the sole reason, you look at this trend over years and years and years, we really don't see many down years in food commodities. And the main reason is population. We all share the common addiction of chewing and swallowing, right? Everyone has to eat. 78 million people a year. And so when you think about the metals market or other types of markets, this is a market that's intrinsically driven by the number of people on the planet. And that population has went up. I can look at pretty much any commodity back 50, 60 years, and world production stair steps with population growth. So we kind of have gravity uphill in the commodities market. We have a natural driver of demand. The global middle class, this was a McKinsey study, is set to rise from 2 to 5 billion people by 2030. Now, I don't know if that'll happen or not, but think about what that means. This is the global middle class. These are consumers that buy cell phones, that shop in grocery stores opposed to wet markets, that save money to buy a car. 2 billion to 5 billion. That's 15 years from now. And it's really driven by Asia. So you think about what that means in terms of demand for food. If you're a food producer anywhere in the world, you have a great future simply based on these demographics. Also, we're seeing a lot of growth in the market for consumer-ready, value-added, prepared and processed kind of goods. I was in Asia last month for a few weeks in China, Korea, and Japan, and I was amazed how many meat products I saw that were convenience, prepackaged sausage, dried meats, all kinds of things value-added throughout the market over there. That's a very rapidly growing niche. So back to that food index. This is the same chart, but this is beef, pork, and poultry. So if we look at what's going on in the global protein space, take a look at this. We saw the beef bubble, and we knew it was a bubble, right? Fed cattle prices went to $1.70. We knew that's not sustainable, and so that bubble popped. But look at where we are in relation. Beef is at a 2.5-year low. Pork is at a 12-year low. Pork has taken it on the chin much harder. And it's economics. It's supply and demand. Beef supplies have been very tight. We haven't added beef production to the world in 10 years. We're basically flat in global beef production. On a per capita basis, we actually have less beef than we did 10 years ago. But we have abundant supplies of pork. And not to mention, we had a Russian ban, which displaced a lot of European pork. And so pork has taken it a lot tougher than the other commodities. This shows that per capita supply basis. You can see there, actually less beef per capita. And so the beef markets are probably going to be a little more resilient than the pork and poultry markets. Now pork, you can see this decline right here. This is 2015 and 2016. With pork, it's different than these other commodities because China has half of the world's pigs. And so any blip in Chinese inventory data skews the global numbers wildly. And that's what that is there. That's an estimate of declining production and supplies in China. And we'll talk about that in a moment. So some of the key issues I want to go over. We won't cover all this in deep detail, but I wanted to just hit on some of them. Brazil's a major meat exporter, the biggest meat and poultry exporter in the world. And they're having some serious problems. We'll talk about that. About EU pork, and then a little bit about China. So the Brazilian recession is very, very severe. The economy contracted by 4% last year. Not only that, they have a debt crisis. They're out of money. They've overspent, and they just voted to impeach their president. So Dilma Rousseff is now no longer the president, at least until her trial is over, which could take a couple years. So you have a temporary president who wasn't really elected, who is in charge of making some very severe austerity cuts, which are never popular. It's hard to do that with weak leadership. I think the Brazilian recession will prolong into 2017 and even beyond. So you look at the pork sector, though. Brazilian pork, this is a cumulative change since the year 2000. In the global markets, Brazil hasn't really done much. Brazil's biggest market is Brazil, and that's really where the growth has driven in their pork sector. Brazil has about half as many sows as the U.S., but they just haven't really taken off in the global markets. Now, they're heavily dependent today on Russia. A lot of their exports go to Russia. They're basically, Brazil and Chile are the only two suppliers that can supply Russia today because of Russia's bans. But they also have a weak currency, and so when you have a very weak currency, your product is very affordable in third markets. And so Brazil is finding enormous success in exporting chicken, pork, and beef. It's their domestic market that is weak because of that currency. The other problem they have is very tight supplies. That weak currency made Brazilian corn very easy to export. And we saw in 2015 Brazil was exporting corn very aggressively. To the point now that they're having some very tight feed supplies. I talked to a guy down there with a company in Brazil, a chicken company. He said their chicken production, he estimated nationwide, was down 10% in 3 months because they do not have the corn. And when you have a weak currency, it's pretty hard to go out in the international market and buy that corn back. And so the corn shortage is serious, particularly for pork and poultry in Brazil. Talk a little bit about the EU. Now we have Dr. Higuera is here from Spain, and he's going to give you a lot better information than I can. But I'll just show you from the U.S. perspective how that's affecting the markets. Two major things happened in EU pork recently. In 2014, Russia banned all food imports from the U.S., from Europe, from Australia, from Canada, and Norway. They also banned EU pork because a case of African swine fever was found in Lithuania. That case probably originated in Russia. Well, of course it originated in Russia. That didn't matter. The ban is on. And so that's a major issue. 400,000 tons of pork and offal that don't have a home. Now fast forward 2015, EU pork production increases an additional 467,000 tons. And so Europe is swimming in pork. They're very pork heavy right now. And it's really been driven, as we'll hear, by Spain. Spain has made incredible advances in integrating a pork industry and growing very quickly. But they're probably going to be steady in 2016. Europe is not going to cut production, not yet. The losses are accruing. They're not profitable today. Feed costs are creeping up. But I think we'll see gains, continued gains possibly from Spain this year. Some of the other countries, France is in really tough shape. They'll probably cut production. Maybe even we may see Germany cut production this year a little bit. But there's no major cuts, I don't think, in European pork production. As I mentioned, Spain, they now surpass Germany, number 3 pork producer in the world. It'll be very interesting to hear what Miguel has to tell us about that. I put exporting 40% of production. He said last year it was 48%. So they're an industry that's very heavily dependent on these international markets. Very difficult times for the EU. The question is Russia's plan working? Russia banned all of this over our sanctions. The Western nations put sanctions on Russia over their action in the Ukraine. Now, as a result, Russia is, quote unquote, nearly self-sufficient in pork. I say that because you ban imports, prices go up. What do consumers do when prices go up? Cut back. What do producers do when prices go up? Increase. So you change the numerator and the denominator, and self-sufficiency of pork in Russia is now 93%. That's a huge increase. So they've, in my opinion, they've kind of become sanction-proof. We can't hurt Russia now externally. They have enough chicken and they have enough pork. And so they just came out last week, the Russian officials, and said this food import ban will extend through 2017. They tacked another year on it. And I wouldn't be surprised if it goes beyond that as well. So it's going to be difficult. There's no good answer for Europe, at least in going to Russia. So if we look at these EU pig prices, you can see the ban very clearly here. If you split that chart in half, there's where the ban hits. This is in euros per 100 kilo. So these are these EU pork prices bouncing along in this 140 to 180 range. The ban hits, and look where we go to. Now, if I take this exact same data and turn it into US dollars per hundredweight, as we consider them in the global markets, the drop is much steeper. So there it is in euros, there it is in dollars. And so you can see how dramatically those prices dropped across Europe. As a result, European pork in 2014 got much cheaper than US pork. This is the premium. Typically, European pork costs more than US pork. This is just carcass to carcass price difference. But what happened in 2014? We saw what happened in Europe in 2014. What happened here in 2014? Hog prices record high as we were going through the PED crisis. So just as the European prices fall, ours go high. All of a sudden, European pork is extremely competitive all over the world. And as a result, we see a lot of European pork going to Asia. We'll talk about China in just a minute, but this is China plus Hong Kong pork and pork variety meat imports. Look at this green line. That's Europe. So here's 2014, there's 15, and there's our 16 estimate. So of that 800,000 ton surplus, 500,000 of it found a home in China. You can see there the U.S., the volatility, the restrictions we have has limited that. But that's where a lot of it went. If we look at market share, this is the EU share of these key European markets. 2014 right there, they've increased to China, they increased to Korea a little bit down this year, but also increased to Japan, a key market for the U.S. So that EU pork has had a major impact on the global markets. So let's shift gears and talk about China pork for a minute. It's incredible what's going on. I mentioned half the pigs in the world live in China. So when you have an inventory shift in a market that big, it drastically changes the global market. The market today is red hot. Supplies are tight. There was liquidation in the Chinese market last year. Not as big as the Chinese government anticipated. They were reporting that 13 million sows potentially had been culled. Not nearly that many were, I don't think. The market would indicate it's probably been closer to 2 million, but it's enough to drive the prices very high. Record high prices. Chinese hogs today are more than double the price of U.S. hogs. It's amazing. You think about what that means. The average Chinese consumer lives on 1/5, 1/6 of our income, and they're paying far more for pork than we are today. Imports are surging, flowing in. You saw the EU number. The U.S. is constrained due to the ractopamine certification requirements. We have to certify pork as racto-free to get to China. And today, I would say 25 to 30% of our pigs are in a system that can access China. But Chinese profits, this is the important thing to understand. Profits are incredible. $160 a head plus. I would say they're higher than that today, just based on where those markets have went the last 2 weeks. So I don't know, you don't know, no one knows how many pigs there are in China. I was in China last month, and no one can tell me how many pigs there are in China. But I know what the prices are. I take an 8-province average of the hog prices every week, live hog prices, and I know what the corn prices are. So margin is probably some of the best data we have. What would U.S. producers do if we were making $160 a head? We would bury the world in pork, wouldn't we? And it's not a lot different over there. Expansion will occur. I know there's some new government regulations that are a little bit challenging for expansion, but they will find a way to expand. There's an estimated 70 to 80 million hog farmers in China. Most of those would be very small backyard farmers. They're in when the market's good, they're out when the market's bad. That's going on today, but expansion is occurring. And everyone in China knows that corn is getting cheaper. The Chinese government discovered they had a 250 million ton surplus of corn and another crop on the way. And so it was in March, the end of March, the government came out and said, we're dropping our corn prices. The government sets a floor for corn prices. So corn that's been $9 a bushel for the last 3 years fell to $7 a bushel. And so if you're a hog farmer and you go, okay, the hog prices are record high, corn's cheap, we have a surplus that's going to take 5 years to work through, it's good times to be in the hog business. And that's really what's driving that. If you're sitting in China, this is important to understand. If you're sitting in China and you look at your price in RMB per kilo versus U.S. and European hog prices, look at the spread where we are today. Almost triple. They're almost triple the U.S. and European price. But back up here, in 2014, there was a spot where we were about equal. In 2010, there was a spot where they were about equal. So this won't last forever. And someday, we'll be back to comparable levels. Don't ask me when. I wish I knew when. But this market ebbs and flows, and right now it is extremely wide. Here's that China weekly live hog price. And it's important to see, where's the seasonal up in the market? When do we expect to see those Chinese hog prices push higher? Right here into summer, right? So we're record high going into a summer seasonal rally, potentially. This price could move higher. I think we'll see it move higher over the summer. The next key indicator to watch, we don't know inventory. We have no good source, no good knowledge of how many pigs there are. But here's Chinese New Year, January, February. That's usually a real seasonal peak in demand. Watch what happens after Chinese New Year. On average, over 10 years, that's about a 25 to 30% price break after Chinese New Year. This year, Chinese New Year hit in February, and the prices just kept going up. That was the first real signal China is short on pork. And so as we lap the calendar into 2017, that will be a very important time to be watching that Chinese hog price to see if we break or to see if that shortage truly continues. Another key driver, another key indicator of Chinese pork demand is food inflation. So this blue line is Chinese food inflation indexed over here on the right side. The green area is China-Hong Kong pork imports from all sources. So remember 2008, the Beijing Olympics, food inflation in China hit 23%. Imports surged higher for a very short amount of time and then fell back as soon as inflation came down. Same thing in 2011, food inflation 15%, pork imports skyrocket. But look at it here. You would have thought that food inflation would have preceded the run-up in pork, and it didn't. Food inflation is very modest. Now, China, the report is that pork makes up 1/3 of the food inflation index. The retail pork inflation right now is 35%. Fruit and vegetable inflation in China is 22%. But yet the food inflation index is 7%. I can't explain that. I don't know what's going on there, but I think that's being masked a little bit. I think the true food inflation is much higher than is being reported. I think it would be double digit if we were to see that. But I track that every month, waiting to see that spike up based on that heavy pork inflation number. So the Chinese government came out and said, we have stocks, we have strategic reserves of pork. When the market gets hot, we can release those stocks into the market. Just the other day, the Chinese government said we've released 150,000 tons of pork into the market to help with this inflation. And so I talk in numbers, but numbers don't quite tell it as well as charts do. And so Now, nobody knows this. No one knows how many stocks the Chinese government has. A couple of years ago, there was a group that estimated around 200,000 tons. I don't know if that's what they have or not. Total imports were 1.3 million tons, but look at consumption. So you think about that. In the country of China, there's 6,000 tons of pork consumed every hour. That 150,000 tons is very unlikely to change the market, especially on a prolonged shortage of pork. Now, there are times in 2011 the Chinese government came to the U.S. and bought a lot of pork to help replenish those stocks. It drove our markets through the roof for 3 months. That's possible, but probably not as likely today as it was back then. Another factor with China is Canada. Our neighbor to the north ships a lot of pork to us. We've become a big market for Canadian pork. They also ship a lot of pork to Mexico. But look at what's happened here recently. Canada was very dependent on Russia. Here's the Canada exports to Russia. The Russian ban hits, and where does all that extra Canadian pork go? To the U.S. We had a lot of that Canadian pork come. But look at what's happened here. And a lot of it went to Mexico. We saw that increase to Mexico. Here's Canadian pork to China, that red line. Look at where that is today. We've seen a pretty good boost in hog futures, right? We've seen a good little run here the last month. A lot of that has been Canada pulled out of Mexico, and they pulled a lot of pork out of the U.S. Now keep this all in mind. China's a hot and cold market. It doesn't stay up forever, right? So this pork may be coming back in the future. So here's what we know. What we know and what we don't know. We know prices. I'm confident in my Chinese prices. Margins are great. We know that the government environmental regulations may have some effect, but we don't know the extent of those regulations. There are many that say, well, the Chinese farmers aren't expanding because the government's imposing environmental regulations. And I say, yeah, but margins are $160 a head. Well, I don't buy it. Expansion will happen. We just don't know the overall level. We don't know the numbers. What I think that expansion's coming. I think it'll take a little bit longer than what we've seen historically. I think by the time we get to mid-2017, there's the potential for additional Chinese pork supplies to start hitting the market and pulling that price back down. If that happens, that causes a major pork disruption around the world. We move a lot of European pork. We have Canadian pork coming back on us. I'll tell you, the Canadians are terrified of what could happen if that Chinese demand falters, because they export 70% of their production. And a lot of that's geared towards China today. So this is something we need to keep in our mind as you look at the markets into 2016, 2017. There's a potential for a lot of disruption in the global market if China cools down. So let's look at the U.S. numbers. This is based on the WASDE report. This is our supply and demand estimates. And this is the 2016 change year over year. Beef, you can see here, this is 1 million pounds. Here's the production, adding to our supply, exports, taking away from our supply, and a reduction in imports. The net result is we'll have 386 million pounds more beef, 289 million pounds more pork. This is the per capita number. So if we look at 2016, if you add those three numbers together, every American is going to have 3 pounds more meat and poultry to eat this year. 3 pounds isn't a huge deal, but it's different than what we've seen the last 10 years. Now let's look at 2017 based on the same report. We add these three numbers together and we get 6 pounds. So what this tells us is in the course of 2 years, per capita meat and poultry supplies in the U.S. are going to increase 9 pounds in 2 years. Look at where we've been. We can go back 10 years. We've had declining supplies, and all of a sudden, boom, there's 2015. Why did the beef market fall? Why did these markets fall? We put a lot more meat in front of consumers, and we are continuing to. And I think the USDA number for pork production in 2017 may be a little light. We know what's going on out here, right? With the additional plants, with the expansion. We've got more pork coming at us. We've got 5 new pork plants coming online. We've got producers gearing up to fill those plants. And so we're in a spot where the whole world is expanding production. China's expanding. Europe's expanding. We're expanding. That should give us a little bit of a red flag, right? This is going to pull more Canadian feeder pigs south. But the real question in my mind, you look at this and go, why are we expanding? Are we expanding because Americans want more pork and we don't have enough? I haven't got anyone to agree with that statement yet. Americans eat a pretty stable supply. We're expanding because there are new plants. We need to ramp up production to fill these plants. That may not be the best reason to expand. The best reason to expand is because consumers want more pork. And the dairy industry did this. The last 5 years, dairy demand was very strong globally. DFA was out there telling the dairy guys, we need more cows. We're building all these new plants, need more dairy cows. Boy, the dairy market is in shambles today. They expanded, they filled those plants, but the consumers didn't need that additional product. The global market slowed, and here we sit. And so I'm just saying there's some risk here. And that's really the dilemma. We have rising U.S. production, and Chinese demand will stall. I don't know when, but markets are like airplanes. We haven't left one up there yet, right? What goes up comes down, and the Chinese market's no different. When you put that kind of profit on producers, they will expand, and that's what's going to happen in China. As a result, we could see pork supplies increase very quickly. Where will that pork go? Well, it may go on the domestic market. We know that all the pork gets eaten, right? It's a sell it or smell it business. It all ends up eaten. The question is at what price? And so here's where we are. This is U.S. consumption on a retail basis. U.S. consumers will eat 48 to 50 pounds of pork. We can't absorb a huge amount more here on this market. It's hard to assume that consumers are going to quickly just lap that up. As I said, the export markets are challenging. Where can you go do that? Here's our exports of pork to China, Hong Kong. So we're looking at 400 million pound increase this year. Where on this chart can we go stick another 400 million pounds of pork? Which tells me it's going to get eaten here. We can put some more into Mexico, maybe Japan, but 400 million pounds is pretty hard to hide somewhere on that chart. And so that's the risk, is the domestic side. So if we look at the prices, the bullish factors obviously are short-term Chinese demand's fantastic. I was at a food show in Shanghai last month, and the sellers just could not get enough supply. I talked to Europeans that were sold out. They said, we have filled every order we can supply. There were Chinese buyers scouring that food show, trying to find pork from any supplier. It's incredible. So that's been very positive. We also have summer demand. We're into grilling season, baseball season, brats, whatever it is. That's been pretty helpful. Bearish side of the forecast is what we talked about. Chinese demand, we've got expansion, and not just pork expansion. We've got beef expansion. Beef supplies in the U.S., beef production is up 4.5% year to date. We haven't seen beef do that for 20 years. We're moving into a spot where we're going to have more beef and more chicken. Chicken's up 3.9% this year. And so that would be the weight on that price. So what I did here, I just ran the Iowa-Minnesota carcass price and then put the futures on here. Now, I don't know if those two variables should be on the same chart. When we've seen what's happened with basis recently, they aren't necessarily the same thing. But this is what futures is telling us. This is what the futures is pricing in as a forecast. Look at where we've been. Times are a little tougher here. And as we look out into next fall, that's where I really start to get a little bit concerned. Late summer and fall supplies in 2017 could be pretty big. I think futures today out there is right around $72 for fall of 2017. That's kind of hard for me to not want to hedge a little bit, at least at that price level, as we look at what's coming next year. So, summary. Current market, we've got some excitement in the market, looks good. China's taking a lot of these excess world supplies, mainly from Europe. U.S. production's rising, but is demand? We'll find out. Don't forget, I mean, this has kind of been gloom and doom, right? I've probably put a little bit of a heavy tone. Don't forget, we get through this thing, there is good days, or many good days ahead because of that global demand. On a long-term basis, global demand is up. The U.S. pork production system is one of the most competitive systems on earth. No one can really compete with us on a pure cost basis. And so, better news ahead. In the medium term, things might get tough, but plan on growth into the future. With that, I'll wind it up. Do we have time for questions?
Anybody have any questions for Brett?
Yeah, Ken.
Thanks, Brett. Really great presentation. Appreciate it. We had a star in Missouri for our new plant.
Yes. That's okay. Yeah, the star in Missouri. The plant, it's southern Missouri. It's a smaller plant. What's the name of it now? Does anybody know? Then I can make it up, I guess. Nobody knows. No, Pleasant Hope. That's right. That's where it is. Near Springfield. And it's not I don't know what, 3,000, yeah, it's the smaller plant. You add all those together, though. You add those 5 plants, and we're talking 30,000 head plus.
Unless some plants close, right?
Yeah. So I don't know. Yeah. Any other questions? Answers? Yeah, we haven't talked about TPP. That's important. The Trans-Pacific Partnership has been passed, has not been ratified. So each of the member countries now have to ratify it before we can implement it. TPP, honestly, was a little disappointing. When we launched the round, we said, here's the deal. Everybody has to go to zero on ag duties. We've got to cut those duties down. Japan wanted in. We said, okay, no preconditions. You have to go to zero. You can take 20 years, but we got to get to zero. We didn't get that done. For pork, the gate price will remain in Japan, which is a major protection to the Japanese industry. But we get a little bit better access. We get better access on processed pork, and we cut the 4% duty down to zero. And so we'd be crazy not to really pursue and try and push that TPP over the hill, but it's not a total game changer for the pork industry. It does give us a little bit of an advantage. It's a much bigger deal for the beef industry. The beef duties in Japan go down from 38.5% to 9%. The Australians already have an FTA in Japan. They're shipping beef at an advantage over us today. So if we do not get that, we're in tough shape on beef. But pork, it's good, and we've got access to countries like Vietnam. We can ship offal. We can ship some low-value cuts to Vietnam. But it's anything but certain. I mean, we all see the news. Americans aren't real thrilled about trade today. Both our major candidates today have said, we oppose, we don't want TPP. So, I don't know. I think the guys in D.C. would say the best chance of a TPP pass would be after the election before January. That lame duck session of Congress, that'll probably be a narrow window to get this thing through. The Obama administration really wants to get it done. But I don't know. I think it'll be tough. I would be very disheartened if we don't pass it. That does not bode well for future trade agreements if we don't get that passed. Okay.
What do you see for new market opportunities? Talk about Japan and China.
Yeah.
Is there other countries that?
Yeah. There are pieces here and there. And, you know, before crude oil fell, there were some good opportunities. And surprisingly, one of the good opportunities was sub-Saharan Africa. We've been watching that for years. The Europeans and Brazilians were shipping over 200,000 tons of pork a year into Angola, into a lot of those sub-Saharan African markets. Angola was the number two buyer of U.S. chicken in 2014. Huge volumes. And so those markets were really buying aggressively. We said, you know what, our hams will compete there. But then the crude oil crashed. They can't afford chicken. They can't afford, they just don't have the U.S. dollars to buy these things now. And so the petrodollar has been a major drag on new markets. When you think of new markets, you've got developing markets, the poorer countries, and then you have developed markets. We're in the developed markets. It's the developing markets, the poorer countries, that have opportunity. They don't have the opportunity with a weak petrodollar. And so, yeah, there's some little things we can do here and there, but until the global economy recovers, until we see better petrodollars, it's going to be difficult to really crack open new markets.
Is there any chance that Brazil continue to spiral down into something like Venezuela?
I don't think so. I mean, Venezuela is on the verge of collapse. The military's taking over, the food shortages. I don't think it'll get that bad. I think they can get out. I just think it's going to take a lot longer than people realize. But, you know, Venezuela, they've got one of the biggest oil supplies in the world, and the people have no food right now. It's a crazy situation. No, I don't think Brazil will go to that level. I don't think Brazil will go into major social unrest. But, you know, when you're sitting there, you've got double-digit unemployment, double-digit inflation, double-digit interest rates. There's just no good answer, and a very weak leadership.